G'day traders, Stacey Burke from Stacey Burke Trading. Just a short video on major round numbers today. I got a lot of emails about some trades last week and about numbers and timings and also some other interesting feedback. But I just want to emphasize a couple of things. So regardless, wherever a session starts, you're inside of a 100 pip box. Wherever that session starts, you're inside of a 100 pip box. We talk about the normal average stop on is 25 to 50 pips outside of the range. So three things markets do. They break out, they fail, and they reverse, come back inside. And they can roll back down to the other side. They can break out. And then they can trend and continue their move up and maybe go further into the next 100 pip box. Or they can break out, consolidate, and retest. I'm talking about over the 3 to 5 days and roll over. But again, three things the markets do. They break out, they pull back, and they trend. They break out and they fail and reverse, and we get false break reversal. And of course we get markets that just stay in a trading range and stay within a high and low range. That's all they do. That's all markets do. Now, the other thing that's consistent, so we know that markets trade in price levels. We know that they trade inside of 100 pip boxes. I talk about three levels of rise. So typically what I look for is a market that will go up three levels and fail. Now that can happen in one session, that can happen over 3 days, that can happen in 3 sessions over the course of the US, Asia, London, New York. Again, I talk about what are your best trade setups. Now, one of the comments I was asked was regarding trade on Friday's New Zealand US dollars. The market had already broken down and then put support in, and then into the close of the US session pumped up. And I talk about understanding the consolidations at the close of the day, the close of the US session, and we'll look at that trade in a second. So the three levels of rise aren't always going to be three perfect boxes. Now, some things that are really paramount to understand is that the smart money is not going to hand you an ABC 1, 2, 3 every single day, every single week for a three levels sell high opportunity. It might be three levels because they're going down to 75 and the previous day's low tells us that because it's below the numbers. Something as simple as that. Or we may get something that breaks out and goes halfway, and they spend a day and a half up there trapping volume above double zeros. Setups like that. Now, again, the same principles apply in the long direction. I'm using short examples because I have a bias to the short side. Now, this same principle applies for indexes, except that in the indexes, this might be a 1,000 pip box as opposed to a 100 pip box, but the same principles apply. A 250 pip range above, for me, is a false break. Now, if they go up and hold volume up there at 50 or 500 pips, which is the same thing, again, we could get a couple of days of trap volume like we saw on the S&P last week. And then they proceeded to march it down below into the lower 1,000 pip box. So critical to understand the numbers, because I got some feedback from some traders who said this is all rubbish, there's no such thing as trap volume and blah 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 blah. And I'm like, well, okay, trade, I don't really care how you trade, and I don't care if you're a real trader. You're not actually worried about somebody else. If you're actually really making money, you're not worried about what other traders are doing. Now, what I'm telling you is fact. Numbers, timings, patterns, and trends. They're reproducible, high and low of the day, major round numbers, the time of day. Somebody asked, well, how do you know when the low's in place? The time of day, the time of day. Okay, time. I talk about New York, I talk about London, and I talk about Asia, and I've talked about specifically the times of day. Now, if you're trading outside of these times and you're saying, when is the low in? Or how do you know the low's in? Well, I know the low's in because I'm only going to the screen at a certain time. Let's take a look at the charts. Now, if we just take a look at New Zealand on this trade for LT, we'll go back and we'll look at the other markets in a second. But let's go back to the beginning of the week. We have Monday. Monday's trading between double zeros and 25. Okay. Now, you'll notice that the previous high of the day, for people who want this indicator, it's not shareable. It's a locked program. I don't have access to it. But I want you to think in simple terms. The previous high of the day is at 25. Now, think about this. Look at that. There's a box of volume between 0 and 25. So when somebody says to me, that's rubbish, there's no such thing as trap volume. Really, well, I have a question for you. If they drop this down, guess who's trapped? So have a think about that when you think that there's no such thing as trap volume. So we come into day one. They break down below. Now, this is your ticket to understanding this. 25 pips below, false break. We don't know that, but guess what? Where the money is the next day for the next day's low of the day, it's below the double zeros. So guess what? When they work into the double zeros and go back into these peak formations, guess who's caught if they drop it away? That's right, everybody above Friday and Monday and Tuesday's London high session is trapped. So much for the people who think there's no trap volume. Now, when this market breaks down, 50% is our halfway of our 100 pip box. The next day they pull back and put in a peak formation. So somebody said, oh, it's just a head and shoulders. No, a peak formation is not a head and shoulders. A peak formation is a peak formation. It's a peak formation locking in the high of the day above 50. We come in, this is our first red day. So on a first red day, we're looking for 3 peaks. I'm looking for 3 peaks to sell in the U.S. session. We don't get that. We get a lower closing day, though. The next day, though, we're, again, previous day's low, triggers breakouts. Do you notice that the low of the day is above the numbers, but they don't go through the numbers? They trigger shorts. They trigger shorts into the market. And then what do? They go back to the high of the U.S. session. So anybody who shorted this, who had their stops up here, is underwater. Now, again, I want to emphasize and come back to the point of what are your best trade setups? For me, it's not about getting into a trade to get pips. Where can you put size on a trade? What are your 5-figure trade setups, your 6-figure trade setups, and your 7-figure trade setups? Think of it that way. So it's not a matter of me saying, okay, I'm just going to load the boat here. I want to know what are your 5-figure trading setups, your 6-figure trading setups, and your 7-figure trading setups. If you don't know what they are, you don't understand yet the importance of setups. Somebody said, well, I only want to trade 2 instruments, so I'm just going to come up with more A++ setups. If this is the only A+ setup for the week on this pair, for a 5-star or a 6-figure trade setup, how in the world do you just all of a sudden come up with other A++, 5, 6, and 7-figure trading setups? You don't. That's why I suggest identifying what your setups are and then being able to understand when they can be executed. So if you're not available in Asia to trade this, maybe you're going to get a 6 or 7-figure trading setup in the U.S. session if you're in the Northern Hemisphere, or you're going to get a 6-figure setup in London if you're only trading London, but it's not on this pair. Understand that. You can't manufacture a 6-figure trading setup in the U.S. just because this is the only pair that you trade. So, anyways, coming back to the question, when the market goes vertical in the close of the U.S. session, heading into the Asian market, what I'm looking for is there a consolidation? If there's consolidation, guess what? There's trap volume, and it's either going to trend or it's going to reverse. This is a pump and dump setup. 3 levels, okay? Understand, guess where the third level is? It's 25 pips below because they're going down into the next 100 pip box. And guess who's caught? Oh, there's no such thing as trap volume. That's who is this YouTuber? Guess who's caught? Everybody above the double zeros. So have a think and understand the importance of the numbers. False breaks, reversals, trend trades, and trading ranges. And understand that the previous day's high and low aligns with these number boxes, and also who's trapped, who's getting triggered into the market before they head to the other side and trigger traders on the other side in the wrong direction. Trap volume up high. Into the new day now, what do they do in Asia? They go up into that level. Trap traders going long. Now let's go to our smaller time frame. So when they head up here, all I'm looking at is, are they trapped? And it breaks down and goes back up into that level. There's our consolidation right at the beginning of the Asian session in our 12th candle window. Locking that in. First entry is underneath for me. I'm waiting until they lock in the high. The high's locked in up here, but I want confirmation now. They lock that in. They break down again into the lower rectangle and trap volume underneath that swing low. Second entry underneath. As soon as they break down above the numbers, I want to get filled above the quarter level, because my thesis is they're going 50 pips minimum, 25 into the guys who are caught above the numbers. Okay? Really simple. Space, 3 levels, because the third level is the gap that they're going to put into these traders that are already caught going long in a broken down market. And if we come back and look at this again, 50 is where we ended the week, Thursday, Friday, day 1, above the double zeros, 3 levels, 1, 2, 3, broken down market. The pump and dump into the end of the U.S. session on a Friday at the first trading day of the month to take out the low of the month of the New Zealand dollar. So you have to be paying attention to the numbers and understand where the third level is sometimes. They're not going to necessarily walk it up 3 levels. We're in a broken down market. 2 levels of rise, 3 levels of drop. Take out the low of the month, trigger breakouts. Who knows? This could keep going down. I have no idea. Okay, same principles apply on oil or anything else. Again, major round numbers. 25 pip, 250 pips, $2.50, whatever we want to call it, whatever instrument we're trading. And you'll notice that the highs and lows, this is a broken down market. We had a trend breakout, day 1, day 2, day 3. They go 250 pips below. Lock in the low. Thursday, Friday, we talked about the ascending triangle coming out of the into Monday's session. We're in the upper part of the box, but they break out. Day 1, day 2, day 3, we had 3 levels of rise. And again, important to understand volatility. When I come to the U.S. session, I've got my major round numbers, and then I go back to my 100 pip box. We have 3 levels of rise. It starts in the lower 50 pips of the box. They go up 3 levels. First hour makes a high and a low. They lock in the high. Specifically for oil and the indexes. 9:30 New York time, they go back up. This is where the trade starts, when they go back up into the third level. 9:30, pin hammer engulfment. There's our short trade all the way back down 25 to 50 pips into the traders who were long on the pump and dump. So if the market moves 750 pips, it doesn't matter to me. I go straight to my 100 pip smaller chart when the session starts. 3 levels of rise, break in structure. New York market opens. They go back up into the third level. 1 push, 2 push, 3 push, engulfment, pin hammer. I want to get filled up at 75. They don't give me that chance. I want to get filled above 50. They don't give me that chance. They lock it in. The high's locked in up here. I got a 1 bar stop. It's 25 pips. Bang. I'm in the trade, and it's as simple as that. So hopefully that answers questions. The numbers, the timings. Just real quick, trader right around this 6, 7 a.m. New York time was talking to me and said, I'm looking to buy the pound. And I'm like, he said, what do you think? And I'm like, well, I have no idea until the U.S. market opens, but I can say this. I know that there are stops over on the left below these pin hammers, and this could go all the way down. I have no idea. I have no idea until the U.S. market opens. My next question is what is your best trade setup? Is your best trade setup to buy the low of the day in a falling knife market? Like for me, I said straight off the bat, it's a minimum of 3 hours. We had news at 10 a.m. New York. So you're thinking, okay, 9:30 opens, 10 a.m. Now we're looking at a third hour minimum. So it's probably into that fourth hour after the 12 candle window, which again, I said it could easily go up because why? We have traders that are in the breakout of the previous day's low, and we know there's a space there. So I said, well, there's a real high probability they're going to go up and get this guy at a minimum. But I said, that's not really what I'm looking for. I'm looking for easy money. Easy trades, not trying to, that's a 4-hour wait for the trade back up, which if you're in the northern hemisphere, this is a great trade. But for me, being in the southern hemisphere, I want this first hour trade. I'll take, 25 to 50 pips with a trend. Not on this particular setup, but, I have no problem shorting that into the low. But I'm down on level 3 and I'd be looking for, 25 to 50 pips. My point being, take a look at the box again. The previous day's low was below double zeros. That tells me something when this is already down here in London. They're going through there. We have stops below here. They're going to go 25 to 50 pips minimum. So 50 is the minimum. Understand that if they break through, or this could reverse off the 50% point of control area of that 100 pip box. But the market wasn't even in New York session yet. So when we get down to double zeros, the 75 area at the timings, with the timing of all of this, so there's your news candle, then there's your little bullpen hammer at the bottom, just inside of 75, that's a 25 pip extension, okay? So understand, 25 pip extensions at those timings. It's about timing, okay? You need to know the timing of when these things happen. That's a false break. That's a false break. At that timing, if you're in northern hemisphere and this all sets up, guess what? You're buying between 75 and 0 for the move back up. And the move is from 0 to 50. That's the point of control at auctions, and then continues its move to the upper part of the 100 pip box. You can call it stop hunting, liquidity purge. I get all these messages with terms and everything. And it's just like, it's a trade. There's a long trade. You got to stop. There's your target. Simple as that. You can call it whatever you want, but 25 pip extension at the timings, after the news, at the New York Open, and reversal, that's a false break, 25 pips. 25 to 50 pips is where the market may put in a low or a high. Gold is a classic example of that. I've said this before. Timings, 25 and 50 pips outside of the 100 pip box. It breaks down, keeps going. Another 25 to 50 pips. When? When the timing window opens. And where do they go? Back to the high of the day. So keep it simple, traders, but really study the numbers and understand numbers, timings, false breaks, levels, reversals, trend trades. It's as simple and complicated as you make it, and then focus on what are your best trade setups. So again, ask yourself, it's not about pips. Where are my 5-figure trading setups, my 6-figure trading setups, and my 7-figure trading setups? Doesn't mean you have to be trading those right now at that size, but if you are going to be trading scalable trade setups and you can't think of it in those terms, they're not scalable. Keep it simple. Going to be a big week. May the markets go with you.